I'm Greg Schnell, the Canadian technician, here to host the Market Buzz. This show looks at weekly setups across the U.S. market. Using the tools available on StockCharts, we'll look for long time frame trades. Please subscribe to my articles and Twitter feed. So Greg is off his schedule for a bit here. I've traveled literally 4 provinces and 3 states in the last 2 weeks, so it's been a bit of a go time. Finally back in the office and just kind of sitting down, looking through what we've got coming at us in terms of the market, and it's been rocky. I was very bullish 2 weeks ago, and then everything stalled. So we're sitting here watching closely to see how this is going to evolve. Market's trying to bounce off the lows and has just gone positive. But as we're working through the charts here, they're definitely weak. We've been down 6 out of the last 8 days, and so hard to be getting more bullish when we're having that kind of gentle selling pressure, albeit selling pressure. But we have failed breakouts all over the place, in the transports, in the semis, in the banks, in the indexes. We can go on and on and on. So there's lots of things that are difficult here. So I'm going to work through some of that. Energy, last week, really bullish off of the news that Saudi would probably tighten up supply, but Saudi's already, as of this morning, got their full production back to 11 million barrels a day. And so that's, I wouldn't say it's pushing down the price of oil, but the price of oil is moving back to where it was from before the gap. I think we're still marginally higher, like maybe 50 cents or a buck. So we're just back to the same environment we had, and if it's based on supply demand, then it might be a little tight. So we're going to have to keep watching that one, but it doesn't look doesn't look like it's going to move the needle like it was moving. So gold is one of the things that's been trying to rally, and today it's pulling back again. But it's just at an inflection point that I think we should just at least, if you're moving money into it, put stops underneath, because there are some setups there that look good. And but literally everything seems like it's on this teeter-totter inflection point thing. And then we'll look around as we head into month end. So lots to cover. Let's get going. What we see here, this is the bank ETF, the KBE, and one of the problems with this particular index or ETF is you can just see that since March of 2018, we've been making a series of lower highs and lower lows. And if there was a place that we were going to expect it to fail, we pretty much found it. JP Morgan broke out 2 weeks ago now, and just stalled. So we had all of this inertia that looked like it was all going to pop forward. And 2 weeks ago, this was the candle for the banks. That was making me pretty bullish. And literally we closed Friday here, and we've been going down ever since. So 2 weeks or 8 days in a row now, we've been pushing down, and we've got momentum below zero, which is, to me, a big problem. So when I look at this, it's not a very bullish scenario to see us fail again and give this back. Now, if we go down for, let's say, another week and then turn right back up, that's the 3 black crows pattern in candlestick charting. But I think more importantly than that, we need to look at a broader context of what's going on. So I want to just jump through my recession watch, and I will say that even from the end of August, things have improved quite meaningfully. So here we have, just typically, this is the top line here, way up at the top, is the S&P 500 price earnings ratio, and then these are the 3 kind of bands of low, medium, and high, and we're outside high. But we're also at such a low interest rate, so that's why everybody kind of says this is just fine. So watching this level here, it's just sitting up here. We're down at the 20 PE level. That isn't that extreme. I guess it's 22, but again, it's well outside this red area. So that's one of the things to be concerned about. For consumer price index, what I was worried about here is that we would roll over, and you see in 2007, 2008 that this dropped. So I was actually watching the momentum curve more than anything to just see what's happening here, and if this was going to roll over, that would be a problem. Hasn't rolled over yet. Here's single family housing, and this update is as of July, but it's still in the range here, so everything's fine there. And when we look at overall housing starts, privately owned, this broke out to new highs here. So, that's still very bullish and looks good, and it's bouncing right off zero in terms of momentum. So lots of upside there. Industrial production, this was tapering down, was looking pretty tepid, and then all of a sudden in July, had a pretty good month. So the reading for August was great. So we get a new reading on that, I think, here in the next few weeks. So once that pops out, we'll be able to update this chart. But are we going to continue to go on to new highs? And if so, that's very, very bullish and hard to argue with. The banking index, I showed you that KBE, which has been declining for 2 years. So that's this line right in here. This is a different one. This is the bank index as opposed to an actual trading ETF. But we see this big uptrend, and we were threatening it back in August here, and now we rallied right off it and now turned back higher. So watching it closely, obviously, if we're going to start breaking this big uptrend line on the banks, that's been some of the more meaningful pullbacks we've had. So 2011, 2015, and 2018, all of those kind of had smaller trend lines underneath them that would break. This would be a pretty major one. So as we continue to make lower highs on that bank ETF, again, I'm referring to this one, this red line, and comparing that to here, that would be a little short red line just across the top over here. What we want to see, obviously, is that this starts to break out to new highs, and it got up there and literally failed and fell back. So tepid is the problem, nothing really kind of shooting up. And then the airlines, they've just been jogging sideways for almost 4 years now, so nothing there. Autos are really pushing down. Tesla looks more like a short than a buy, and we're sitting right on this horizontal trend line. Now, it wasn't too many weeks ago, I think it was just 2 weeks ago, that Ford broke out to a new, I think it was even a 52-week high. Let's just go pull up Ford. And on this chart, it was... it had started to break this uptrend and popped back up and started to move. So it was looking better. For some reason, I thought I had that at a new 52-week high. Obviously, my mistake. But we're not seeing the strength in the autos that we were seeing. They had started to bump up, and then they just kind of paused. The railroads, again, you can see that there's kind of 4 or 5 meaningful trend breaks on my chart here in terms of relative strength compared to the S&P, and we've recently just broken one here. All of those were associated with pretty meaningful drops: 2011, 2009, 2008, and in 2006 we kind of just had this was probably a pretty big pullback at the time, but we're sitting here with the PPO right at zero, saying, what's my momentum? And the bottom line is it's been flat for the month. And the real question is, does it roll over and start to fall away, or does it just bounce back up? And then I just have to subtly adjust this line a little bit and say it found support, and we keep going higher. Trucking broke out 2 weeks ago, same kind of chart pattern as the banks, and then it's pulled down. It's testing the bottom of that big candle already. And so if trucking was going to be weak, and we saw weak FedEx earnings, so that might be part of that. Looking at the Dow Jones World, we can see that this one didn't get up anywhere near the July highs and has pulled back and is starting to roll over. And as we watch this, there's a definite uptrend here that, as time goes by, we start to put pressure on. We haven't done that yet, but holding in this kind of sideways range for pretty much the whole year and haven't been able to go anywhere. And I do want to say that some of the wave swings we've had recently, like over the last 4 to 5 months, where May was up, June was down, July up, August down, September up. These wave swings have been, 5% each way. It definitely, without question, it's kind of the most volatile momentum indicator I've seen over 5 years now. So when we look back at that, that's pretty wild swings. This is the Treasury yield. And again, I'm not getting any new data from any of the bonds here, so I don't think there's value in going through them all. This is the Nikkei, and what we were watching for here is, is the Nikkei going to break down? It just keeps holding at this 21,000 level. Its momentum trend is down, but all of a sudden, in the last 2 weeks, it started to move back above zero. That's pretty bullish. And you saw that in 2017, and it was a good year-long ride. But we're seeing these, all of these trend lines get tested and momentum levels get tested. So in August, this was starting to make lower lows. Now it's making higher highs. So just on a global basis, it's not as clear. So the point I want to make here is when we go through a lot of the recession data, it's not helping us to see if things are actually breaking down. They actually look like they're improving. Unfortunately for the charts like the Dow Jones and the Dow Jones World Index that I just went through, and here's the New York Composite, same thing, didn't get anywhere near the July highs. And we're making lower highs in terms of momentum, so that's not very bullish. When I go through the bullish percent indexes, they're at a level where they're just kind of holding, but not great. I think like the NASDAQ already had, 8 or 10 of the NASDAQ 100 have already fallen below the 200-day moving average in the last week. So that's how tentative it was on that particular reading. The Russell, another stranded high here where we went up, tested, tried for a week, tried again the second week, and then have pulled back. And, we're falling back down towards the 40-week moving average. That's just not that bullish. So a lot of this data seems to be pulling back, and we saw the VIX spike again this morning, but we haven't done any real. We're trading in the same range we kind of traded at from noon yesterday, and so just keep watching the sideways trend. But the semiconductors, same thing. They ran up, they did make a slightly higher high, pulled back, and are falling down again. The S&P, I think this looks pretty much like a rollover, and we just couldn't get through these previous highs in terms of the RSI, and the PPO is making lower highs and lower lows. Well, lower lows, and now it looks like a lower high as it turns down here. So all of the indications that I'm looking for that the recession is coming isn't showing up on the economic data, but yet the charts are weak enough that we could fall down here. So this is an awkward spot for for me, just trying to figure out where we're going. But look at this workhorse. This was just a beautiful stock running really, really hard. Got all the way up here. This is a small cap 550, one of the really strong names. It's kind of like, specialty finance software. We're seeing it in these cases, and it runs up, and now it's just literally spent the last 2 months without kind of the upsurge it had in the earlier spring, and now it's gone sideways for 2 months. Doesn't make it a fail, but you can just see the momentum is clearly waned out of here. So I want to take a quick break for commercial, and then we're going to come back and look a bit more into the gold charts and some of the other areas of the market, and just see if we can find, some other structural strength. With that, we'll cut away for a commercial. Be right back. Okay, and we're back with the shiny metal. We're talking about gold. And one of the points that I'd like to make on the gold chart is it's a rally after we've kind of put in a high. And so now we want to watch what's going on. And here what we have is the bear shares are starting to improve. So this is a 3x chart going the other way. So when gold falls or gold miners fall, then this chart would start to pick up. And what we saw here was a big push down, huge volume. Look at this volume kind of coming in here. And then we rallied up and we pulled back down. And if anything, if this was going to find support here, then this chart would continue to be gold going down, so it finds support and this chart heads back higher, or we see gold break down and this chart would gold break out and this chart would continue to break down. So it's really just showing you how tentative the situation is. If we go find, here's the bull shares just to operate on the other side here, what we see is we broke out of this range, we've run up now and we've pulled back, and now the real question is, does the PPO turn higher well above zero, which would be very bullish, right? Positive momentum at increasing speed. And so we're sitting right in here and we're below the 10-week moving average. And just in general in commodities, it's nice to be above a 10-week moving average on any chart you're on. It's a good place to watch for inflection points. So the gold charts aren't that bullish. They're sitting right near their highs, but recently over the last 2 weeks, while the market's been pulling back, they've been starting to improve. So let's just go to the summary page here. And from here, we can flip it out to say, whatever, 1 month. And what we see is, these really small ones. This isn't kind of the names we want to look at. But these stocks that have been, the high scooter ranking stocks, they've been whatever, just kind of in the same range as the rest of the market. Up 5%, down 5%. It's been a pretty mixed area for the last 2 months, I'll say. And so if the gold stocks are going to start to break out here, this is a really important place to watch. And I think, for all of us who like to trade the commodities, these things can move really, really fast. So I'm continuing to watch those levels. And if we just go look at GLD here, you can see it ran up and it's put in a low, now tried to rally up, and now it's testing the prior high. If it starts to fail here and fall away, you're making lower lows and lower highs on momentum here. So this is a bit of a problem. And if it rolls over, then this trade would be over. If it starts to turn higher, again, you want to be back on this train because it looks like it could run for a bit. I actually think that the treasuries, the TLT and those types of charts are tracking with gold. And so you see the pullback here and now the rally back up. But the treasuries have been extended so far. I think the most of that move is done for now. So what I'm watching for as we go, as these move here, is if all of a sudden we see a quick turn down in momentum on the bonds, I'd probably see it on gold as well. Now, one of the other places we like to look is the Japanese yen. And, we see a run up, a pullback. Now, the yen yesterday made a big move and so did gold. And then here today, the yen is a little weaker. So I think this is an important level, call it the 92 level on the yen. And if this starts to break down, that's a bigger concern, and probably we'll see the TLT and the GLD follow with that. So this is more difficult, is probably the way I'd like to say that, than just, kind of picking a direction. And here's JP Morgan, and what we've been watching for here is this 115 level, 116 level, and it was trying to break out. Well, it's just held here for 2 weeks. So we haven't seen any real breakdown yet. But on the other hand, the breakout just stalled. Literally, what we had kind of 2 days. So this day and then the next day. And then it hasn't been able to do anything since then. So it wasn't like a whole bunch of new buyers are jumping into these bank stocks and trying to get them going. All of that leads us back to the Russell index. And what we see on the Russell, again, on the weekly chart, just zoomed in here. Just want to go to 2 years. What we see is these waves that we've had here where we're kind of down and up 5% each month. Doesn't look like much on this chart. When I scrunch it into 5 years, you see it a little bit more, that these waves are actually pretty meaningful. But we're sitting here bottoming out right near zero. And what we want to know is, can we turn up or do we break down? And again, momentum's been relatively flat for the last 4 months. And I think if you look at your portfolio, if you were in momentum stocks, you were doing great, and all of a sudden you got killed recently. And if you were in commodities, you were getting killed, and then recently you had a rally, and now all of a sudden that seems to have dried up. We have 2 more weeks before the president of China is coming to to the US. I think it's the week of October the 7th. So that date starts to become pretty meaningful. And again, that's roughly 2 weeks today. So as we're watching for those trade talks to either get something done or fail, I think the market could be on hold going into that. But I really do think that the market will probably, like it did on Friday when the trade talks ended a little early and they didn't go over, they didn't go travel out to see the agricultural sectors. When that trade talk finished early, the market dropped. I think the Dow dropped 300 points or something pretty much immediately on that news. So it's a pretty high stakes time frame here. And also we're heading into fourth quarter earnings. We've just finished quadruple witching in the Fed. So there's a lot of stuff that the market's trying to absorb and price in. We've got the Iranian situation now. We've got political situation. So there's more things weighing on the market. And as we head into earnings next week, I think that's probably the going to bring those earnings numbers back into the fore rather than all of the other news. But looking around the world, like if I go look at the Shanghai, which was so bullish, what you saw was a nice run up here. And recently it ran up and it made, it was trying to break out to a new high here and then rolls back over. And so for the last 2 weeks, this was an outside bar. And then this bar so far is lower highs, lower lows, and a lower close at this point. So it's not like the optimism is showing up in China, whereas we had the PPO just starting to turn up here. Again, if it's going to come down, bounce, and then fail, this is not good. If it comes down, bounces, and takes off to the upside, that's extremely bullish. So we're at this flat line where we've got no momentum either direction in that way, roughly for 3 or 4 months now, where we're I'll call it declining momentum with small couple of week surges to the upside. I saw a cartoon yesterday and it was, here's our 9 cartoons so far on getting a China deal done. And there's a bit of mockery going on because they haven't been able to close a deal. It's a big deal. It's hard work. And, I don't think it's very fair to kind of mock the efforts. We have to get, if the US and China aren't going to trade together or have a lot of barriers to trade, that is going to slow world economies substantially. So when we look at the CAC Caron, and it was down hard this morning, it was down 1.5%. This thing has been trying to break out for 2 years and literally finally broke out last week and got above new 52-week highs at least. It's not all-time highs because it made bigger highs way back, like many years ago. Anyway, this is just stalling here for the last 3 or 4 weeks. They've been within 100 points, and I think today we're tracking below the prior lows here. So all of the global picture looks stalled as well. And I have the one chart in a chart list called VGW, or a VGW chart in a chart list. And I just want to show you this from a perspective. It looks a lot more like, there it is, XVG, not VGW. VGW is a stock. This XVG chart basically gives the same weighting to a $2 stock as an Amazon, or a $20 million market cap stock to an Amazon, and equal weights it. What you see back here in 2000, so here's the scale down here, 2000, 2001, these dark lines, each one of them are a year. And what you see is this XVG chart chopping and chopping and chopping and going really nowhere. And what we've done basically since the December low is we bounced off it, and now we're making lower highs and lower lows. And, if the 40-week moving average, look at, in some of these cases, it just runs on it for a year. When it falls below, it was a test, and then we come back up and we fail, and it's another year. Like, it's pretty clear. And then we get here and we have literally chopped up against this thing 3 or 4 times already this year. So it's pretty choppy times and choppy water. And I was pretty convinced when July rolled over that we were probably going down, because we were rolling over below zero, and this was a bad place to be. And when we get down here with a full stochastic below 50, and this is some special settings, but just when you're down in this lower part, the overall market is usually correcting. And I think most of us know that from 2000 to 2003, the the S&P 500 was correcting. And then we had a big bounce off of there, and then we got to 2007. And at the end of 2007, this went below 50, and we stayed down there for a year and a half. And then here in 2011, this was the European financial crisis with Portugal, Italy, etc. 2015-16, this was the drop in the commodities, and we went below 50. Well, here we are. We've been below 50, above 50. Well, we went below 50 in 2018, fell back down, above, below, above, below, above. And so what would normally be a little smoother to evaluate, we see a lot of this chop, and the market's really undecided as to whether or not we have the structural strength. From the global PMIs, one of the things that we see is this market getting weaker, the manufacturing getting weaker and weaker and weaker. And yet we just had some things like the Citigroup Economic Surprise Index turn up above zero for the first time in a while. So there's just so many conflicting messages. So if your portfolio is getting whipped around, I think one of the more important things to stay focused on is just, don't let winning trades become losing trades, and don't let use the price action to help you in and out of the market. And if you find that you're making more trades than you normally would have, that's probably because the market's whipping you around. It's moving 5% each way. So all of a sudden you're getting back into trades, and they're literally running for a week and getting back out of trades. So very difficult period here to try and work through. And again, one of the things that looks more optimistic is that some of the breakouts we're trying to hold, but semis, trucking, banks, even the commodities had started to push up and now have rolled back over. So there's lots of things that aren't working. Just one thing before I forget, I do want to show, I have started to try and collect people who are interested in my subscription service, and that subscription service, I'm literally trying to get the payment process set up. So as soon as that gets finalized, I'll be able to send out newsletters attached to those emails and all that kind of stuff. If you'd like to get on that list, you can just go to gregschnell.com and put your name in here. And as we get that going, I'll be making that available, and it'll be, a much more reduced subscription level than I hope to put in place later on. So if you're interested in that at all, at least put your name on this list, and you can either do it here or down below, either one. Put your name on the list, and then as we go forward, hopefully literally in the next few days, it's been a delay. And so hopefully this is about to kick off and I can get that set up for you. So anyway, just to make that point. Lastly, I think the one thing going back to the markets is, as the market trends here, again, the last 6 out of 8 days have been selling days. So some rally is due for a few days here, but the market's pretty weak when it can't seem to bounce. Now, most people will say we never pulled back much. I agree, we didn't pull back much. The real problem is we're heading into fourth quarter earnings, and there's quite a bit of expectation that we're actually, as the FedEx guy said, we're seeing a lot of economic contraction and slowdown. So those kind of things are making me a little nervous that the numbers are going to work out well for us coming into the fourth quarter. So I remain cautious, try and watch for that. So thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern Time and 7:30 a.m. Pacific Time on StockCharts TV. You can also catch replays on the StockCharts YouTube channel. Thanks, everybody. Bye-bye.